Welcome everyone, happy Tuesday. Thank you so much for taking the time to attend today's webinar. It is top of the hour, so I want to be respectful of your time and get started. I'm Reneika Lightbourne. I'm excited to have the one and only Kaylee McMahon. She is known as the apartment queen. She's a founder, general partner, key principal with nearly $65 million of asset under her management. Thank you so much more, Kaylee, for being our speaker today.
Thanks for having me.
Absolutely. So she'll cover how to passively invest in apartment complexes, how she specifically targets apartments that may be on the secondary market that's in need of updates for better returns, and then, of course, how she works with investors like yourself to be able to build passive income. Before I hand it over, I do want to just kind of give you an overview of what self-direction is, some of the different investment options relating to self-directing, the account types, and then, of course, the 3 steps to get started with us. If you have questions, feel free to type those in the question box. We'll answer as we go, but also allocate some time at the very end to finish up any additional questions that you may have. Again, my name is Reneika Lightbourne. I'm one of the business development specialists. I've been with Advanta as an employee for a little over 2.5 years now, but I'm also a client of Advanta for about 4 years. So self-directing is something I personally do as well. If you have any specific questions in terms of your scenario or you want to do a deeper dive, feel free to give me a call, send me an email, but also too, I would encourage you to visit our website at advantaira.com. It's a great resource, anything and everything relating to self-directing. Just a little housekeeping before we get started. At Advanta, we don't give any tax, legal, or investment advice. We also don't endorse any particular products. So we always encourage you to, just understand that this is, educational purposes. And then, of course, consult with your professional team, whether that's your attorney, your CPA, or financial advisor before you make any investments. A little history about Advanta. We've been in the business for nearly 20 years as one of the leading self-directed IRA administrators in the business. Our headquarters is in Largo, Florida, which is the general Tampa Bay area. Advanta is also in Atlanta, which is where I'm based, but we do work with clients nationwide as we have nearly $2 billion under administration. One of the ways that we separate ourselves is, providing our clients that concierge-style service, meaning you have a direct point of contact, a dedicated account manager once you are a client of Advanta, and then, of course, our educational platform that features experts and guest speakers like Kaylee to be able to, knowledge share with you. So just 3 key takeaways. Know that any IRA or former employer plan qualifies to be self-directed. You choose the investment. So in this case, we're going to be covering, passive investing, real estate related assets. And then, of course, all of the income generated would flow back into your IRA. So exactly what is a self-directed IRA? In its simplest form, it just means, as currently constructed, it just means that you have complete control over your retirement funds. You have control over the investment decisions. It gives you the ability to really diversify your account. You can use IRA funds to invest in likes of real estate, whether it's a single family or multifamily like Kaylee is going to cover today. You can use IRA funds to invest in tax liens, notes and mortgages, precious metals, oil and gas. The list goes on in terms of the options available to you. So why do people choose to self-direct? You can look to self-direct for many different reasons. I'll just touch on 3. 1, the stock market, the ups and downs. No one can really time the market. Whereas with a self-directed IRA investor, again, you have the ability to diversify your account, put your money into tangible assets like real estate that we know always retains some value. 2, it can be a new source of capital for you. So if you have funds sitting in an old 401k, you can elect to roll those over to make your next investment. And then finally, the tax benefits. Having those rents, those dividends, those profits flow back into your IRA account, tax-free or tax-deferred, just depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, for individuals, just know that any type of IRA qualifies. So with the traditional tax-deferred money, or Roth IRA, after-tax dollars, if you are self-employed, have a side business, small business, you can look to self-direct a SEP, simple or solo 401k. A solo 401k has the higher contribution limits, a lot more flexibility. A lot of real estate investors like that if you qualify for it. Some smaller accounts that can be self-directed includes ESAs to cover education expenses for your children or grandchildren. You can also look to self-direct an HSA to cover medical-related expenses. Having an HSA is more so dependent on having a high deductible plan. But any former employer plan, whether it's an old 401k, 403b, or TSP type plan qualifies. The key thing that you want to remember is different contribution levels varies. And then, of course, based on the account that you have, and then with the Roth, the distribution would be tax-free at retirement as long as you've had that account for 5 years and you're 59 and a half. In terms of getting started with us, we've really, simplified that for you in 3 simple steps. 1, open up the account. We'll walk you through that process. You can do it online. You'll have an assigned account manager once you have an account with us. 2 is funding the account. Are you moving funds from a former employer plan by doing a direct rollover, or you transfer from existing IRA? You can move as much or as little as you want to and need to make your investment. There's no tax liabilities for you to do that. Or are you going to make an annual cash contribution? We'll use a combination of all 3. And then finally, step 3 is start investing. What is it that you have an interest in? Do you want to just more so be a passive investor and invest in that multifamily project that's in Texas or Georgia or wherever? So I'm going to go ahead and turn it over to Kaylee, but before I do, I just want to really quickly bring to your attention, if you're not aware, or encourage you to take action, that Congress is looking to restrict your ability to invest, to self-direct your IRA. So the proposed changes in the $3.5 trillion spending bill, if enacted, unfortunately, will negatively impact your ability to control your retirement account or what you invest in. So, for instance, they're looking to limit or prohibit your ability to use check for control LLC feature or a trust. I know a lot of real estate investors like that feature, but they're looking to take that away. Your ability to invest in private placements, whether it's a real estate fund or a syndication project or a private company. So we would encourage you to reach out to your local representative, your local congressman. Advanta, along with many other leaders in the industry, has verbiage or letters that you can use to redirect to voice your opinion. This is your money, so it should be your choice. You should have the ability or the freedom to invest in what you feel works best for your retirement account without someone overreaching or trying to dictate in terms of what you can invest in. And with that, Kaylee, I'm going to go ahead and hand it over to you.
Okay, sweet. Thank you so much for that wonderful. Oh, I have to share my screen. Hold on one second.
Yes.
Oh, look, there's nothing there. Let me pull up my stuff. So if I just do present mode, it will just show everybody the same thing. Sorry, my main screen thing is so small over here, I can't really tell.
Yes, you can. There you go.
It's good. All right. I don't know if y'all can see my face still or not. I'm used to Zoom and the other different ways to do this, but hopefully this is entertaining. I'll try not to drone on for too long because I think that you covered a couple of things I was going to cover. If you guys have questions, I'm not sure if I can see them in the chat. Oops.
Yeah, I'll definitely let you know those questions come up, and feel free to emphasize anything that I talked about, especially when it comes to that spending bill, or encouraging investors to reach out to voice their opinion. It's affecting everyone, not just Advanta clients. It's nationwide.
Yeah, I already wrote our senators. Apparently, like, people are saying to write them every day. I'm like, you know what? I got 3 different other things I got to deal with right now. But for sure, you got to actually take some action. So today what I'm going to cover, y'all, is passive investing in apartments and what it can do for you. What's in it for me, FM. I want y'all to tune in right now to the radio station. You can get strong returns and get your life back. So let's talk about that. This is me. 760 doors under management right now. We're buying 2 more complexes that'll close this month, actually next week. So that'll get us towards, I think it's like 970 units, 60 units, something like that. Anyway, so it'll be 70 million assets under management at that point in time. I'm at 64 something right now. And so formerly was a single family flipper, hated it. Residential real estate broker, I still am one. And actually next weekend I have to spend my time renewing my license, which is not fun, but it allows us to be able to pivot a little bit whenever the market goes nasty, I think, in 2023. Also, biggest thing here is I'm an advocate for women's independence and specifically empowerment financially and financial inclusion. And so all of our projects, as you will see, have all of our operators being awesome women who have experience. We're professional. We have everything to offer that's necessary to make sure that these projects succeed, especially being very conservative when it comes to picking the project and running our numbers. So that's one thing that I'll find. So wanted to let you guys know that that's a part of my why and a part of our business as well. So let's talk about the problem that you may be facing right now. The problem that a lot of my investors are facing is that they can't do it all. They think they can do it all, or I used to think I could do it all, but unfortunately you can't. So you can't find and analyze good apartment deals. It's a full-time job while you're also maybe working full-time. Maybe you're still flipping houses. Maybe you've got, I'm not sure what, full-time or part-time job looks like, but I mean, really trying to find deals in this market today, it's a full-time job. And you got to be trained to spot deals. So it also not only comes from experience, being able to analyze data appropriately, and then have the advice of other mentors and sometimes more experienced people who have been through several cycles. At least that's what I utilize. So running these deals and finding them and touring them and etc. is a full-time job. Negotiating, inspecting, raising money, post-closing duties, managing without experience is a disaster. And risking your capital to secure deals is part of that full-time job. So for example, if you're me or an active operator and you're going, okay, I want to go take down this $15 million deal, but I got to put 1% to 2% earnest money hard day one. I got to risk a couple $100,000, day one that is non-refundable. That's a big risk. And so really when we talk to our LPs, limited partners, or passive investors, we're not talking to them about investing until we've gone through all the due diligence and we're sure that this project is going to perform how we're projecting. And then at that point, we reach out to our network, which we already have established, and say, hey, we have an opportunity for you. So point is doing all this when you haven't done it before or don't have a team really to be able to leverage all of your different skills. It's just a disaster. You'll need to also execute your plan, rain or shine, based on experience. That's what I'm saying, based on my experience. For a minimum of about 5 years these days, you're running a large company. So this is not a hobby anymore. That's the biggest point to get across. You can't, dabble in it like you can flipping houses. When you're running an apartment complex, it is a big business. I know it's got a roof on it that looks like a house. And a lot of people, like when I was in Europe, they call it residential, and it technically is half-half, but in the US it's commercial, and it's, you're running a big business, so you have to look at your operating expenses, your OPEX, I'll go over that in a second, but you just cannot do all this by yourself, especially if it's your first time. Bad idea. You'll have to learn operations, you'll have to learn financial modeling, you'll have to learn commercial real estate construction direction, which is different than single family. You have to be able to put together a pro forma, a timeline, hold people accountable, all of your workers accountable, make sure that payments are being processed correctly, not on your own, but leading a team that's doing that and being able to make sure that you're keeping everybody accountable and making sure that all of the numbers and the performance match up with your pro forma, or basically your plan. You're spending your time project managing. So for example, I'm doing a deal in Amarillo right now. I'm lucky I don't have any kids. I'm going to be out there 2 days in a row every other week. So I'll be living there kind of part-time when we get into the really heavy part of our CapEx or our capital expenditure renovation process to get it really going. So you'll be spending your time managing those deals. You'll have to learn property management software because you got to know enough to be dangerous and be able to look at what the property management company is giving you. I've got a board in my office kind of going over, certain reports that we need to run daily to know money in, money out. There's certain things that you have to know what it's called. You have to like right now I'm going through reclassing a lot of our fees, reclassing a lot of our CapEx because it's put in the wrong place, which obviously reflects poorly on our financials because it's done incorrectly. So you have to be able to know enough to be dangerous. So I've had to do some training programs and then also be able to just learn it through experience. Also staying available means there's less time for your hobbies. So if you're going to be an active operator, say goodbye to your hobbies for a couple of years until you have scale. And that's what I mean by running a big business. You really can't do multifamily or multiple multifamily units without scale and without people and systems. You're going to be spending a lot of time driving without your family. They may get excited at first and say, oh, I want to come and, on site visits at first, and they'll join you a couple of times, and then they're going to be like, no, I'm not taking that 5-hour trip every other week, that they have stuff to do, soccer, etc. So you'll be missing out on time because you're driving everywhere or flying, depending on where your properties are. So just keep all that stuff in mind. You kind of have to start over when you're getting into multifamily for the first time as an active person. And at that point, when you're focusing like I am on building a business, you don't really have that time available anymore to pursue your purpose or your passion. Just keep that in mind. That's an issue. So here's where things start to break down. You know, your time is limited, so you'll spend more time searching for deals than making money. And why I say that is because I'm speaking from experience. You'll be lacking time to pursue your passions, as I already mentioned, and facing the real reality of truly not having financial freedom sucks. You know what I mean? Me, sometimes I look in the mirror and I have to say that to myself, that I'm making a sacrifice early on in my career for a handful of years to be able to get to financial freedom, whereas my deals I provide to others, they can just take advantage of financial freedom right away. So that's where things kind of break down and you're going, what am I doing? So here's the solution. Passive income from experienced sponsors so that you can focus on your mission and your why in life. So this is what we do, or what any active sponsor would do on a deal. We make you money, or they make you money. So they find you deals, they negotiate, secure, raise funding. We also secure multi-million-dollar loans. You also would need Fannie and Freddie experience for, so meaning that you would have to have already taken out a $12 million loan with Fannie Mae or Freddie Mac, specific to multifamily, not single family, and have the experience operating and exiting the deal, or operating the deal already, to be able to qualify for a new loan. They don't just let anyone that's never done it before sign on Fannie or Freddie. You have to have experience. You have to have the knowledge base to operate. So we are the ones that worry about the tenant turnover. It does keep me up at night sometimes, the beginning of projects. I'm laughing because I just went through that. Now we're over 90%, but oh my God. Upkeep on our properties and even capital improvements by our set business plan. And the only way it's going to happen is by having the asset manager consistently execute. I got to keep showing up, rain or shine, like I said earlier. There's no, life happens with my role. There is you show up. That's it. So tasks and projects: we inspect, improve, asset manage, refinance, triage disasters, which is a big one. So I've had a couple of fires, a couple of floods, and there's a process for getting the max amount out of the process of an insurance claim, etc. So we're experienced in that. But constant reporting, because we have to make sure to be accountable and show our investors how their investment is performing. Distributions, all of your tax forms, so pressuring, hiring, working with a financial CPA professional to try to get your tax forms to you on time and make sure that they're correct, and amending when they're not. Position the property for sale, and so much more. I mean, it's a full-time job. We do it for you. Why does experience matter when you're looking for a sponsorship team? Because I can vouch from experience. As a company grows, communication and cross-functional collaboration become more complex and more important. The more experience that's on the team, that helps us to know the next steps to take on no matter what is happening in the market. So if you have a crash, if you have COVID, if you have whatever, I mean, it's all scary stuff, but when you have experience, you're able to reference other points in time where something similar happened, the great crash, or certain things are not all the same. This COVID models more so 9/11, for example, as far as how it's impacted the economy and what's happening. The point is that there's experienced operators that we have that are able to put our heads together as a council and decide how to move forward and what next steps to take. And it's more important, again, as the company grows and there's more positions and there's more need for collaboration. Here are something that you may not have thought about, or a couple things you may not have thought about. These are some benefits that you may not expect from passive investing. So one, you can build your portfolio. So this is something that not necessarily be you have to go out and find assets to be able to bring into your portfolio, but you can have other people do it for you, basically. So you have your set criteria of what you want to invest in, and you just find groups that align with that, and they'll basically build your portfolio for you. So what does building your portfolio do? That helps you to increase your net worth, right? So usually that helps you in your life to be able to leverage for more real estate projects, other loans. There's quite a few things that building your portfolio will do for you, tax advantages, etc. So taking advantage, multifamily properties, specifically passive investment benefits that you get to take advantage of downturns. So for example, when people are not able to get qualified for loans for whatever reason, or maybe the housing is becoming too expensive for them, you actually get to take advantage of those downturns because they come to apartments, number one, and then also apartments are a large property, so we have scale and we have more units. So for example, if we have downturns, we have more more units to be able to spread out the risk across, and to be able to spread your investment out across as well. So we can take advantage of people moving in, and then also take advantage of the fact that we have more units to be able to spread out the risk across. And then also you get to, you already know this, I think, but you get to just collect checks and watch your money grow. So that's a great benefit of passive investing. You get to build a reliable stream of passive income without taking on too much risk. I already mentioned earlier, when you are the active operator and you're going with your risk capital, you're putting money up front. Sometimes it's non-refundable, or as we call it, hard, day 1, week 2, whatever it is, but it's money that, if things don't shake out, it's lost for good, So when a passive investor gets involved, they're getting involved in the stage of the project where it's reliably going to be an asset that we're going to move forward with and close on. And then again, so you're not putting up, say if you need 100, 200K to be able to put down as an earnest deposit, you may be investing 50K into a deal. So, it's a more secure point in time to be able to invest your money in that deal. And then also, you're not likely putting up as much money also. I mean, it'd be great if you were. We've got a couple investors that are accredited and they'll put $250,000. But anyway, point is that it's reliable. It's building a reliable stream of passive income for good without taking on too much risk. Another benefit is that it's saving you money on taxes by ensuring that you don't make passive income in a higher tax bracket. So basically, what this is doing for you is you have losses. And I'm not going to get too much into it because, again, I'm not a CPA. But there are tax advantages you get from taking losses for the first year of your investment against your other active income, depending on your career. And then there's other ways that you can actually help to get other depreciation benefits towards your other assets, your other income, etc. So tax benefits are awesome from your passive investments. Your passive income, you make passive income without risking too much of your own capital, similar to where I mentioned earlier that risking too much of your own capital. But again, this is passive income while not risking too much of your capital. Investing through a sponsor can provide the desired level of passive income that you want in your life and less risk than a stock or bond investment. So again, we're talking specifically here about real estate investing. And so, of course, I always like to make that comparison. Some investors don't like risk. Some investors do like risk. It just depends on what your risk tolerance is. So those are a couple benefits you might not think about. Like I already mentioned, there are tax advantages, but also note this specific one. If you are a real estate professional, so if you're already in construction, if you're already a real estate agent, if you're already doing real estate related activities, K1 can mean K1, or the type of income that you get, passive income, can mean quite a bit for you. You are not subject to passive loss limitations, and what that means is that, for example, if you're married or you have a partner now, it's considered this way. Then if you basically, for example, made $100,000 in passive income, and you had made $100,000 in active income in your and as a real estate professional, and your passive, if you made 110, so basically, point is that you can offset your active income, and if there were remaining amounts that you could write off against your active income that you had over, normally that would be a carry forward towards your next year of losses, but your spouse can actually take those losses. So again, there's no passive loss limitation. So if you have additional losses, you can then take it against your spouse's or partner's income. So it's beneficial for everybody. So I would say go find you somebody that's an active real estate professional, so y'all can both double win. And then again, you can also invest tax-free in other ways too. So you can invest into the deals tax-free by using IRAs. You can also structure those IRAs, because sometimes there's additional taxes that you have to pay, or penalties called UBIT and UDFI tax. There are things that we will cover at the end here as far as what kind of account types that you can move your self-directed. So you can move your IRA into a self-directed account that will not incur UBIT or UDFI tax. So I know that Advanta offers those, and so we can talk about that at the end. We have Q&A. How do I get into those? What are they called? Because I'm going to have our specialists answer those questions. And then, like I said, did we mention you can invest tax-free with your retirement account? So you have no tax investing into these deals. So you're investing with a self-directed account that's already post-tax, typically. That's my understanding. And then once it's post-tax, then you're in this deal and you're making money, and you make this money tax-free, and then it stays in this account. So isn't that great? And depending on the types of account, there's a variety of things I could add, but I'm not gonna. So basically, also want to add to this about liability. And so if you're a passive investor, another advantage that you get is that you have zero liability if the asset goes belly up. So for example, when you're a general partner, depending on the type of recourse or non-recourse loan that we sign, either way, there is the potential for the project to go belly up, and for basically the bank to come after us as operators individually for our assets, our businesses, our homes, not in Texas because it is a homestead state, so they can't come after our asset. But point is we have, like sometimes, depending on how much the investment is, etc., unlimited liability and type of loan, whereas the passive investors, limited partners don't. That does not happen to them. They have a limit on their liability. And then I just want to note here, crowdfunding is coming from us. So if that's something that you're interested in, that's something that we can also take IRAs in the future on. That would also go around these UBIT UDFI taxes. So let me move on to the next slide. Oh, and did we mention there's less work involved with passive investing in apartment buildings? So the capital that you invest can go further, meaning that passive investors get a better return on their investment than those who don't use passive investments. Sounds kind of dumb, but there's a lot of people that just don't get into any kind of passive investing, so they never feel what it's like getting that income and having those losses and what that does to your taxes, reducing your overall expense ratio or expense percentage as a human being. And so when you have less expenses, then basically that means you have more income. So again, you can do that also with less work. Isn't that amazing? So what methods can I use to invest? And this is a general statement. You can use cash, you can use your retirement accounts tax-free, and you can also use types of, not cryptocurrency, yes, cryptocurrency investments, but that's only certain types of providers that offer that, and certain types of platforms, for example, that offer that. So I just gave an example here. Crowdfund Main Street is one that you would invest your IRA into once it's self-directed with a custodian such as Advanta IRA. And they would be able to convert, but anyway, or take crypto. So I'm not going to click on this for you guys because I want to get through some Q&A. Currently, right now, we have 400 plus happy investors. I actually have 15 more as of this morning that are in my portal that are waiting to fill out documents on an investment that's closing on the 25th, and they're all trying to get their wires in this week. So we'll have another at least 15 more on that deal, but we have the opportunities in the future, obviously, if you're looking to get involved. So normally I would click this link and then it would take you to my website, which would show you all the benefits that we offer our passive and some active investors, or some offerings for active investors. So just go to Apartment Queen Investments, theapartmentqueen.com, and that will lead you in the top menu bar to all the different benefits that we offer our 400 plus active investors. So this is a generalized statement of how this works. So this is how ours works, but each operator is different, and so it's always good to have these things in mind as far as how long will this take, what does the end goal look like, etc. But really in the beginning, the first couple of things that are so important, and we find our best investors are, number one, they're educated. So that's the first thing you need to do. Obviously, understanding right now you're doing it, getting involved with, okay, how do I invest tax-free? Okay, what are the penalties? How do I make sure that I'm able to grow my family's, this is a net worth play, over time, a generational wealth builder. How do I do that? What are the benefits? What are the pros? What are the cons? That's another great thing to know, so that you also will then figure out what are your investment criteria. So when you go look at other operators' deals, you know what to look for. Then for us, what we do is when an investor feels like they're highly educated or educated enough to be able to met the benefits and risks of deals, then we ask our investors to get qualified. So we have a quiz for them. I will give you guys the quiz at the end. Basically what that does is it tells you, am I sophisticated, am I accredited, am I neither? And what that would do is that would tell us on the back end which type of future opportunities you've qualified for, because we don't ever want to pair someone with something that doesn't make sense for them, where you have to invest too much and put too much capital at risk that maybe would put you in an uncomfortable position if the deal doesn't go well. So we want to make sure to take that into consideration. Then after you're qualified, what we do is we have, not right away sometimes, but we will have offerings available. So basically what it is it's a deal, as we usually call it. And so we'll have offering documents for you to review. We'll have that on our portal, and usually that will include some sort of underwriting, which has all the numbers and basically a pro forma that we put together on the performance. We will have a webinar for the property, and the webinar will usually be, it'll always be online. We usually do them in person as well. But point is you'll get, because you're on our list after being qualified, a link to the webinars that are available. Then once you've decided, okay, this makes sense for me and I want to get involved in this deal, and this looks like it's going to work out for me as far as my criteria, then what you do is you look at those back of those documents, and then you can sign them, which is called executing a subscription. So there are different types of offerings, and each operator has different types. Most do Reg D, D is in Delta. We do Reg D, we do Reg C, and I'm looking at doing a Reg A+. All that means is these are different, these offerings have different criteria and different investors that can be accepted into them. And so without getting too much into the weeds, basically the documents, the set of documents you'll get will be different for each offering type. But the generalized one that everyone understands is the Reg D, so that would be a PPM, private placement memorandum, a subscription document, an investor qualification, and then you'd want to look at the company agreement and sign on that as well. So basically, those are the generalized ones, but if you were doing like a crowdfunding, a Form C, you're going to have a Form C is different set of documents, et cetera, et cetera. So I won't go into too much detail, but you basically sign the documents, and then once they're executed by us, then you'll get a receipt or basically a another copy of the executed documents. Then at that time, it will say in there, and then also know for us, again, it's different for every operator, that there's a time frame that we put as far as how long you get to be able to, business days wise, wire the funds, because you have the subscription and you have the wiring instructions in your documents. Then once the funds are received and we close the property, you will be getting this is again how we do it, you'll be getting an email confirming that we've closed the investment. Here's what our reporting schedule is going to look like. Here's what we expect moving forward. And for us, you don't get your first email until a month after takeover, because we need a month, 30 days of data to be able to even put a report together. So point is, and then moving forward, you just be getting mailbox checks, mailbox money. So that's how our process works. Again, every operator is a little bit different, but this is just a generalized outline so you know what to expect. So this is just a little bit about us. So we started in 2018, and currently in 2020, we had 400 investors. We had 20 million as a team raised in total, and that got us to that 750 door mark. And that was in, like I said, 2020. In 2021, we opened our first crowdfunding option for non-accredited investors. We did shut that down. We don't have that available anymore. We're going to be opening another one I'm going to shoot for before Christmas. And the generalized purpose in doing that type of offering is so that we can lower the barrier to entry for women to get into these deals. You know, we are already facing, like I mentioned, it's a passion of mine. We're already facing the wage gap. We're already facing the issue where psychologically we are taught to invest, we're taught to not invest, but instead to save and donate. So with all these things in mind, and then, you know, half of us are divorced, and you typically have to upfront children's expenses first if we ever get those, you know, reimbursed or not. Just heard from my friends how that works. But point is that we typically just don't invest. And then if we do, it's like, okay, now I'm 50 and I have a retirement account that's been added to over my entire lifespan. Now I can finally invest. But what we're doing is working on lowering the barrier to entry where women can start investing in their 20s. You know, we don't need to wait till the end of our life to start making wealth, so that way we can increase the wealth in our households in America and increase the amount of accredited investors, and the more that we can do and be empowered to take care of ourselves and our children better. So it's a little bit about us. Again, I'm not going to click on this link. I will be happy to share a copy of this if you'd like, the presentation, and then you can look on the link that leads you to our website, and then also this link, which is a 3-minute long video that goes through our why, our motivation, and why we do what we do, and my personal story that got me to want to do that. I won't play it now, but again, like I said, we will, if you want the presentation, I can include it. Oh, and I think that is it. So let's see what kind of time we got. We've got some time for Q&A.
Yeah, absolutely. Great presentation. So a couple questions that came in. The first question is, what is the anticipated hold term before sale? Is it 3 years, 5 years, 7 years, 10 years?
Yeah, so what we shoot for right now that seems to be reasonable is 5 to 7 years. You know, we're looking at some projects that might be 10 just because they're newer vintage, so they're not the quick flip type model. They're a little bit different, but it would be something that, you know, would be like a 2002 build. Again, not the typical model, but we've got a couple of family offices and bigger groups that are interested in doing those because they don't mind holding for the 10 years and just, you know, getting paid the cash flow in the meantime. They're not in a rush to get out. So typically it's 5 to 7 years, but we are looking at some longer holds for those investors that want to stay.
Okay. Next question is, do you have an example of a project that you've completed?
Yeah, sure. So there is an example that I could share if you'd like, the write-up, if you will, is what I call it. So basically, can I share my screen, or stop sharing my screen, just share my face?
Yes, let me. I think you should have the ability just to put on webcam and not. Hold on 1 second.
I'm going to answer your question. if y'all can still hear me, I'm going to go ahead and answer the question, and then hope that my face comes back. But basically, yeah, so I've got a couple of performance write-ups, if you will, because the first one I learned on was 18 units, and it was in Texas. And that one was one where I was not the lead, I was learning. So I would have to have the lead's permission. Well, I did, obviously, to be able to share all of the performance and numbers. But because it's in Texas, we're not actually allowed to do one of two things. We either cannot share the name of the property and can share the details of what happened, which is kind of what I did. I wrote up what we bought it for, what we did to it, how long it took, when we exited, how much we exited for. Or, I could basically say, here's the property, go Google the pictures of it, and then I can't give you details of what we bought and sold it for, essentially. Texas is a non-disclosure state is what I was trying to get at. So the other projects that we have, like they're all in Texas, basically. I've got one in Phoenix. The Phoenix one, I could just all day, say, here's what happened, but we haven't exited that one yet. And I think what we're going to do, actually, we've decided, I think we're going to hold it, and we're going to refi the investors out, because we bought it for $70K a door, and we're looking to be able to refi out like $70K a door, because the comps are not the comps, the other properties nearby were selling at $120 a door when we bought it, at 71. So anyway, long story short, there should be plenty of equity in the property to get the investors the money, and maybe just hold it long term. But like that one, there's no, I can disclose whatever, because it's in Arizona. So I'd be happy to share that narrative with you if you'd like. I didn't put that together to share on this call, but yeah, I'm happy to give that to you. There we go. So my email, if you'd like more information, is admin, ADMIN, at theapartmentqueen.com. And I'm happy to share that narrative if you'd like.
Perfect. Thank you so much. Next question is I'm guessing you do a cost segregation. How much is recaptured are you having to pay at the end of the project?
So it just depends on, so as far as recapture, it depends on how long we hold the property for. But yes, we do a cost seg. That's definitely, whether you're in my fund as a member in that, or whether you're individually in our projects. Yeah, we always do, because they're always a project, or so far, that has been old enough to be able to really take advantage of some of that. And I find out from a builder recently that even when it's brand new, we can still do it. Anyway, so yes is the answer, pretty much for life. As far as the recapture, so it just depends on how long we hold the project. Always over a year, so that the capital gains rate lowers after a full year. So always in our pro forma, we want to wait to sell until after a year. And so if for some reason we didn't, or we got this crazy 3 cap offer or something like that, and we were going to exit, that would be the part in time where recapture may hurt the investors the most. Because the capital gains rate would be higher at that point in time. But obviously, yeah, I mean, you're correct that we are not in the projects I am currently in, or have exited. We had not set it up as, hey, for sure, all the investors, we're going to be 1031ing a group into the project. That is something that I am looking at with these longer holds, offering the investors that ability, but we have not done that. So yes, there is recapture. Otherwise, if we did structure it as the whole company doing a 1031, we could definitely avoid that. But yes, it does happen.
Okay, next question is, you mentioned that you have properties in Texas and Arizona. Do you invest in other states?
I haven't. It's something that I looked at in the very beginning, but knowing that there's quite a bit of opportunity still here in Texas in secondary markets and sometimes tertiary markets, where you have the ability to still add a lot of value and still be able to get into the property at a lower basis. If you're finding a community, like for example, I'm kind of hot on Lubbock, Amarillo, that area out there, and then obviously, wait, sorry, I said Amarillo, Lubbock, Abilene, and Amarillo is what I meant. Those ones, as far as the administration right now, it's pro-oil, so that's going to be good for going into any of those areas, basically. And it's not in Midland, Odessa, so we're going to be able to take the traffic from Midland, Odessa that does not stay there, once the oil goes on its up and down roller coaster, if you will. So as far as other states, to answer the question, I really have not spent time. What I would do is, if I knew another experienced operator that was boots on the ground that lived in a state like Georgia, in a state like Florida. And they had, like I said, similar experience to mine. Probably some construction experience would be great. Asset management for sure would be absolutely crucial. And I mean, like on a large scale for quite a bit. Then I would look at other markets. Right now, the only other market I'm kind of thinking about is Memphis, Tennessee. I'm not 100% sure right now if that the appreciation that I need is there. The cash flow is there for sure, and the ability for the like higher cap rates that we wish we could have here in Dallas, like an 8-9 cap that exists there. It's growing. Big GM factory with 5,000 new jobs. The newer Amazon facility, it's another 1,000 jobs. There's quite a bit of all the metrics we need, diversified economy, et cetera, that fit there. However, the appreciation I'm not sure is there. So I'm exploring that right now. But currently, yep, Texas, we have one in Phoenix.
Okay, next question is, what are the risks in investing in multifamily, and how would you deal with the down market?
Oh my God, I would need to do a separate webinar on the risks. There are so many risks involved in multifamily because, I mean, market is, I would say, if you have a experienced property management company, and that changes based on the size of the property, their professionalism, the systems they have, the amount of supplies, how they work with contractors, if they already have a contractor in-house, if they have a company that they work with all the time. I mean, there's a variety of things, even just with the hire on the property management company, that are risks just there. The way that they open accounts, the way that they do their billing, like I'm having to reclass a whole bunch of expenses because the CapEx wasn't put on our P&Ls correctly. And so there's risks of having, someone like me that doesn't know that we have to do it a certain way, or maybe there's a risk of like a certain local bank that like I've had before where they don't monitor anything. And they're just like, yep, turn in your reports, anyway, there's unlimited risks. I mean, and so point what I was making was that if you have your risk reduced by having good communication with a good property management company that you've worked with before, that is in markets that you have been in before, or they have for sure been in before, that should be a lender requirement. You have adequate reserves. You're not over leveraging the property, which I would say would be over 75% LTV, loan to value ratio. There's risks in development. For example, if you have a part of the property which is not just renovations, there's no cash flow, you're building ground up, that's another risk. I mean, it just depends on the class of asset, the property management company. Again, if all these things are put together, I would say that your risk is reduced by probably 70 to 75%. So the remaining 25% of your risk then revolves around the experience of the asset manager, which again, like I mentioned, there are a lot of things that I haven't experienced before. And so I basically have an unofficial and official board of people who have been through these things, and try to partner with people that have more experience than me. So when I run out of ideas, then they run out of ideas, and we have someone else that has 80 properties, and we say, okay, what ideas do you have? That way we have more experience to be able to lend to any situation. I mean, floods, that's a risk. Fire, that's a risk. We've had all that happen. Freezes are risks that turn into floods, that turn into etc. Death is an issue, is a risk. These are properties that have people in them. Lawsuits are a huge risk. I found out that whether it's the team that's suing themselves, or which is just idiotic, or if there is someone that's in your property that's suing the property management company, and they can't be held liable, so it goes to us, or whether it's, I mean, there's so many risks, getting into the thing. If you have a good experienced operating team, and then you guys are getting into like self-storage, that's a really kind of low risk for a value add type property. But multifamily, that's why the returns are so great, is because you have all those different levels of risk. And like I said, I could go on for another hour about all the possible risks, but basically I think that your experience as an investor, or even talking to another experienced limited partner, would be a good way to say, okay, well, and as mentioned before, having your team around you. Okay, I've got a CPA that looks at this. I've got an advisor that has my whole picture in mind, my tax picture in mind, planning in mind. I've got an attorney that looks over like the PPM, private placement memorandum. They look over the operating agreement. They try to find issues that may arise that are a risk for me. There are certain things that you can do to check and reduce your risk. So like I said, I could go.
That's a great answer, great detail. I have a couple more questions that came in, one of which is, how are you handling evictions or the moratorium issues that stem from the pandemic for your specific projects?
They're over for us. Like, to tell you the truth, the only reason that We had an issue at this moment in time from probably, what is this? This is October now. I think summer, we still kind of like pre-summer, I'd say May. We did have one property manager that was, jacking around, to tell you the truth, and Texas is a very landlord business and tax friendly state. And so here, as far as being able to push up on a judge or push up on local regs that are saying you can or can't do something, we definitely will push, and we'll push until we get our way to allow us to run our business. So I find that Florida's the same way. They were a leader when it came to being able to not necessarily statewide lift all of these things, because you still then have certain effects from the moratorium on your loan, because they're a government-backed loan, which has nothing to do with the city that you're in, for example, or the municipality that you're in. That could all be clear, but then you still have issues with your loan, or you took a forbearance on your loan, and so then you cannot evict people. That was something that we didn't do on any of our properties, thank God. So basically, we didn't take a forbearance, so we were able to continue to evict as soon as we were able to. So we've had properties, that have gone down. I've had one that's gone down to 68% occupancy, taking all the people out that wouldn't pay, and then they got to go, and then we have to go in and tweak a few doorknobs and make the paint nicer, and then go find a new resident that can qualify, that can pay, that has a job. So far, long story short, overall in the portfolio, we've only had 2.5 properties that have had an issue. One went down 1% year-over-year collections. I wouldn't even consider that an issue. One of them, it was in the middle of construction draws, and the person that picked the lender, again, it was the lender that was the issue. So we've had to work through that. And then the other one was the property manager would not, so we just have to reason with our people. So the property manager here would not evict certain people. And we're like, okay, look, if there's not a certain set of criteria to take the people in the first place, which was the issue was the intake, we don't want the people in our property anyway. So we were lucky that we were able to, at a certain point, be able to move them, evict them, etc. So overall, it was an issue for a little bit, but hasn't been a debilitating issue.
Okay. My next question is, how do you find your off-market deals?
Not enough. To tell you the truth, really, if I could find more people that would just focus their entire attention on looking for those, that would be the optimal way to do it, because the brokers, they know what they're doing. They have ads out there. They have lists of people that they have been calling. And in the DFW Metroplex, for example, I'm going to get this number wrong, but somewhere between like properties that are multifamily, that's the limit. So all the brokers in, like, say, Marcus and Millichap, there's like 15 of them, and they already know all of the contact people. They've been calling them, telling them. And brokers will usually tell me that it takes about 50 left side to get someone to think about it or start having those conversations about listing. And it's just because the market's so hot, they're willing to go, okay, well, we'll slap $2 more million on it and give it a shot and see if we can get it. So really, it's brokers. I can go on forever about the magic sauce that we've figured out about what questions to ask them. But what it is not all of them will do it either. It's, have I closed before? Have I performed before? Can they trust me? Am I a good person? Do we get along? There's a lot of factors there, and it's based on personal relationships, but then they'll have deals where they will just get the basic financials from someone. And then there's the ramp up period from the whole market cycle of listing, where you then get the photos and get the OM, the offering memorandum. You have to whole market process, all the ads before they go and spend all the money on all that stuff. There are certain myself on relationship to where we ask to see the deals before they're listed. So technically that's off market, but however, they do know that some it's a good deal. It doesn't mean that you're going to get it for a lower price. Actually, sometimes what I see is that they go, okay, this one now, for example, they're like, okay, so he definitely wants 16 million if it's off market, and or before we list it, and we're going, oh, the numbers make sense at like 14.75, at the max. So we're kind of not going to be able to, we wouldn't be able to put in an offer right now. We can, but they would say no because they have a certain number in mind. And then when they go through the full marketing process, then what happens is the owner gets to see what the market will bear. And then based on my experience level, I can typically get to second best and final unless it's like this huge $300 million, buy-in where they, their margin of appropriate possibility is 15 million. Mine's 1 million. It's not 15. So anyway, point is, full marketing process. Sometimes we can get it at a lower price because of what the other offers that come in at, because the market what offers they can get. So it's broker relationships, and then through bank relationships, and really if there is someone that is focused on just looking for that, they would be able to do something. That's not me, unfortunately. I have to talk a lot.
Okay. Next question is, do you invest in your own deals along with your passive investors?
There's some deals that I have and some deals that I haven't. When I first got started, I for sure did. Now that the deals are getting larger and larger and larger, it's usually what happens is I put in the risk capital up front, so what it takes to go take the deal down. Sometimes that ends up being hard money, so it's hard earnest. And so what I'll kind of do is say, okay, well, that will basically be my my investment into the deal, and so it will my money will stay in the deal. So I mean, I guess the answer is yes. And then some of them, I have other partners like on this deal that I'm doing now, where they wanted to put so much in that I go, okay, well, we've put in like 40% as a LP, or sorry, LP, as the GP team. We really don't need to put in any more. Now we need to bring on LPs to bring in the remaining. Otherwise, there's going to be like 3 spots available for investors, period. So on that one, I put in very little just up front, to secure the deal. So the answer is yes. But it varies depending on the deal and what we're all putting in together as the general partnership team. But as a team, we always do put in 10 to 16% at a minimum of the total raise.
Okay, and that leads me to the next question that came up. How is the deal structured in terms of profit sharing with LP and GP?
It depends on the deal. So basically, the 70-30 split to 80-20 split, somewhere in that range. So it depends how far away it is, how much effort it's to find it, how much effort it's going to take to renovate it. If it's something that's a real easy deal, we don't mind saying, okay, 80% problem. If it's a huge deal as far as the upfront raise and capital costs to take it down, again, we have limited time to raise them, so we'll our split. Like my fund, for example, I have made it an 80-20 split. After doing 7 deals, we want to be more generous. Some that we're doing where I live in the property, CapEx done, take away my life. So on that one, we did a 70-30 split, so that it was more for us to operate and to deal with the thing. So it just depends on the deal, but it's 70-30 split to.
Okay, you were breaking up at the very end. The next question is, do you have a minimum investment requirement?
Yeah, so typically we follow the market average of $50,000 minimum investment. What we tend to see with sophisticated investors is that's their normal or their norm. And then when it comes to accredited investors, typically they'll invest $100,000 to $250,000 for their minimums, just because their net worth is higher.
Okay, I have a couple more questions that just came in. So how frequently are distributions made? And then how often do you communicate or send out updates regarding a project?
Yeah, so what we do as far as distributions is they're paid out quarterly, and the quarterly starts typically, and so again, each project is different. To ask that question again when it comes to a new project or a new fund for documents. But typically what we do is that there's a 1 year of value add. So again, if we're going and buying something that's newer, we're not going to have that much value add. So it'd be probably 6 months. And depending, I mean, I've had friends that have done it in 90 days. So it just depends. But point is what we normally do is there's a period of value add that we need time with interest only from the bank to do all of the renovations, to fix whatever is wrong with this business, whether it's vacancy, whether it's operations, whether it's property management. Mostly there's always some kind of appreciation component, so a capital component that we need to go in and improve the building, and that takes about a year. So long story short, we pay out quarterly, and we usually pay out quarterly after year 1. But again, if it's it could be a less of a time frame. What was the other question? Sorry.
So how often will you communicate or provide updates? How often is it sent out?
Yeah, so we use a software called InvestNext for our investor portal, and I or my investor relations team, what we'll do is we'll communicate monthly, especially when there's change. Then when there's stabilization, it'll go to quarterly. So the investment documents say quarterly, but we'll just go ahead and do monthly because we kind of have been brainwashed that we have to do it during COVID because, during the lockdown, because it became so like iffy for everybody. They wanted to, up-to-date info. So what happens is in the beginning, usually we have a construction project. When things are changing, it's really important to stay up to date on what's happening because some scary things may happen where we have a dip in occupancy, we have a fire, we have issues, whatever it is that happens. And if the investors know sooner rather than later, they tend to be a little bit more receptive to our plan and to be able to have a little patience with us, right? So it's important when we're having big changes happen that we're doing it monthly. And what typically happens is when all those changes are made, all the new residents are in, we're saying, okay, this is going to be our cash flow. Now it's improved from where we bought it at. And now we're going to basically keep collecting checks and do distribution on the property until it gets to the point where we can refi, give the investors their money back, or sell, and give the investors their money back that they're expecting. So basically in that situation, what was I answering? Oh, the communication, once it's stabilized, like I said, would go to quarterly.
Okay, I do have two final questions, but I want to answer a self-directed related question really quick. So yes, all of the income generated from the investment flows back into the IRA. You can, once the income flows back, you can elect to, reinvest it into another project, send it over to a brokerage account if you want it to be in the stock market. But if you do take it out prior to retirement age, depending on if it's not for a qualified reason, then yes, you would be subject to possible taxes and penalties. If you want to talk more specifically, feel free to give me a call and we can go through all the details relating to that. The next question for you is, so the question is, what is your view or landscape on the real estate market in general, and more specifically, multifamily?
Okay, one thing I want to ask before I answer that, because that's a intense question. Is there a chat box or somewhere where I can send people something?
So yeah, there is a chat box. I don't know if you have control of it. I know I have visibility to it as the host, but if you look.
Yep, I see it.
You see, okay.
Very bottom, and then I can select organizers and panelists, organizers only, presenter only. I don't think I can send it to everybody, but I can send it to you, and then you can send it to everyone, maybe.
So are you able to type to where, if you type in the chat?
But hi.
Okay, so it just came over to me privately, but do you?
It gives me the option to message organizers and panelists, presenter only, or Advanta IRA organizer/presenter.
Okay, so unfortunately, it doesn't give you the option to put it in group.
I'll send you a link real quick. So what I want everyone to have is this link, if you can send it out. Basically, okay. What it is, I mentioned earlier, if you want to get qualified for our future investments, you have to become friends or family with us just to be safe. Sometimes accredited investors can get into like my fund, for example, which is a Reg D 506C, all day, any day, as long as you're accredited, and you could do it today, yesterday, whatever. But this is a way that I have qualified for. But then when we're answering the question about the real estate landscape, that is a tough question. And I have these really bad notes that I was going to type up, and I've got an investor quarterly update that we do. And so it's really important for us to stay abreast of what's going on in the market, right? And in the market in general. So liquidity, loans, what is happening with inflation? When is inflation going to hit? What causes inflation? What signs am I going to see? One of the good things that I'll say for sure is that real estate investments such as multifamily benefit from inflation. So it's not a horrible thing. So for example, without getting into the very details, there's a couple of things that show me that inflation could happen. But I believe that inflation is going to be running year cycle. So what I really see, for example, in loan terms of what's going on with our market, I believe that if we continue to purchase properties, I would say honestly, moving forward from December, moving forward, that are Fannie Freddie, I don't see any issue as long as we keep using that long-term 10-year debt structure up until about May 2022. Once we have that locked in, I believe that Fannie and Freddie, the interest rates will not change up until May 2022. So I'm very confident with that. Now, as far as some of the properties that we have right now that are on bridge, I do see that there could be an issue or a change in mortgages by May 2022. So again, if we have bridge loans out there, what I want to do is get in there, have that buy into a long-term structure, because like I mentioned, I believe by May 2022, we're going to be seeing some changes in interest rates because of inflation. The interest rate, the inflation will happen for a short period of time. It won't be incredibly life-changing. And everyone says that it's happening now. Yeah, it is starting to happen now. But like I said, I think it's going to really hit and not be great when it's 2022. So there may be some residual effects that I don't know about that are going to hit, but as projected by another company that I'm partnered with, Ross Perot's company, Hillwood, that they actually predict, and their economist has been right for quite a while, that in 2023, the residual effects from forbearance on properties from COVID, from the lack of or the over leverage of certain properties that I'm seeing right now come available only on an assumption basis. I'm also seeing, like I mentioned, that these loans, not loans, sorry, that the capital markets based on I would have to do a full another webinar on this, because then we have to start talking about like the bond market, when the government starts dumping bonds and when they start buying bonds, that's when we start seeing changes in interest rates that would then affect our loan and our rate spread. And so again, without getting into too much detail, I believe we're going to be solid till about May 2022 with a lot of the things that we're seeing right now. I believe that a lot of the crazy things that are happening in residential and commercial markets are going to continue to be that way. And so there's going to be a time period here in the next, year, a little bit less than a year, where like right now we're trying to go after secondary markets specifically because there's, this property that we're having a contract now, or buying it for $21K a door. Like I can't get that in Dallas Fort Worth. I cannot, if I look in San Antonio, we're at like 77K a door minimum, you know what I mean? So, and that's high crime, so anyway, long story short, I believe that a lot of the patterns you're seeing right now are going to continue until May 2022. And then I believe in that time period, then we're going to see interest rates start increasing. And that's when it would be fortuitous right around that time to maybe start diversifying and doing different things. Staying in a long-term loan structure will withstand that change, again, because we have that rate lock with the loan. And that will actually be an advantage on the back end when we have a lower interest rate loan that is locked in. And so then if people are wanting to buy that and their interest rates are going up to 7, 8, 9, whatever it's going to go to, then they would look at our assumption as being a very favorable thing for them. So we could basically at that point sell at any time, even if we have a prepayment penalty, if you will. So I think that the cap rates are going to continue to go down and get smaller and smaller. I think that the interest rates are going to continue to stay low or go lower. Sorry, I could go on another webinar, but and I would be happy to discuss that with you. I should probably put one together, but anyway, I see it being pretty crazy continuously. Prices are going to continue to increase here in Texas. Tesla is officially going to be going to Austin. Prices are going to keep going up. It's going to get a little bit scary, but I would keep buying, for another little bit less than a year. I would say I'd cut it off probably right after spring, because when it starts heating up and people start waking up and pay attention in like April, May. So I guess I would not buy moving forward after May for about a year until we see how things readjust. And then you might see properties that are going to be in desperation for getting out of their over leverage because they haven't had cash flow for so long based on forbearance and other things.
Okay, great information, great presentation. Thank you so much for answering our questions. Any final thoughts before we close out?
The only thing I would say is that, doing sessions like this is so important. Getting educated is so important. I get a little frustrated with certain organizations that are out there that try to make this process of investing, eat like in a box, make it so easy for you. Like if you follow these rules, you will always win. Like that doesn't exist, guys. And ladies and gentlemen, it does not. So certain types of loans, being able to pivot and be creative and looking at different types of deals, and especially people that have invested in different types of deals that are not maybe that cookie cutter thing that you're being fed. I think continuing to learn about those and be open to new things and doing your research, listening to economists, all of this information that is either bad hand notes or whatever came from Dr. Mark Dotzer. He's my favorite economist that I follow, along with the internal staff, like I mentioned at Hillwood. And he seems to take a very realistic, long game historical approach to what has happened in every market over time, and then apply it to a smaller window of where we're at now in a realistic but positive way. So he is a good one to listen to. He's from A&M, that's where I went to college, so of course I like him too for that. But there is a thing at A&M called the Texas Real Estate Center, and it's the best real estate center in Texas. And I'm not just saying that, but it's just because of the amount of research and data that I actually use in analysis for our properties. Census data, city-data.com. There's certain crime rate sites that we use to look up all this data. Well, they only go back to the last census. They only go back to the last dip in time that they were able to take information. However, Texas A&M Real Estate Center, they have data up to 3 months. So each quarter they have up-to-date data on population growth, income growth, crime rate decrease. I mean, all the things that we use. So continue to be educated, know about the deals that you're getting into by doing that research, and don't just follow the blind cookie cutter way of doing things. I don't. And so far that has led me to have some success. So I would just continue to get educated. And then also, please communicate with your senators in your state about how you want your hands off your IRAs, guys and ladies. I mean, that's all I gotta say.
Thank you so much. Yeah, so our final question just came in. Yes, this webinar is recorded. It's going to be on our YouTube channel within the next 24 to 48 hours, so you can always go back and rewatch the recording. I would also encourage you reach out to Kaylee directly at theapartmentqueen.com. If you have specific questions relating to self-directed, feel free to give me a call, send me an email, or visit our website at advantaira.com. Thank you so much, everyone. Thank you, Kaylee.
Yeah, thank you.